And welcome to this week's look at the news stories that are affecting the markets so far and look like they're going to continue to do so. And what are we going to take a look at this week? Well, firstly, we're going to start with the Nasdaq 100, and obviously that's reached a record high just this week. We'll also take a little look at sterling, Great British Pound, see potentially what could happen with the Bank of England rate decision coming out. Thirdly, we'll take a little bit of a look at a surprise decision earlier on Thursday morning by the SNB to cut their interest rate. And we'll finish off taking a look at Brent Crude oil, how that's been doing the past few days. So, the Nasdaq 100 reaches 20,000 points. Back on the 30th of May, we noticed uncertainty in terms of price behaviour on the US Tech 100 Mini, as we call it, at FXOpen. That was near the 18,840 point resistance level, which is shown by arrow 1. Now after that, it dropped and tested its former resistance at 18,250, that's arrow 2. But then the longer lower shadow on the candle that you can see there indicated aggressive demand, and in fact the bulls broke through the 18,840 resistance level. And June, the rally continued within the ascending channel in green, and that was driven by the prospects of AI implementation and also prospects of a Fed rate cut. Monday of this week saw the US Tech 100 Mini rise by approximately 1.2%, reaching and breaching the psychological level of 20,000. That was supported by some influential analysts raising their forecasts in terms of the stock markets. Goldman Sachs have said that the S&P 500 end of year target has risen from 5,200 with them to 5,600, 5,600 points. Evercore ISI actually increased their S&P 500 target from 4,750 to 6,000 points, quite a significant increase in their forecast. Also, of course, have the anticipation of FOMC members' comments coming out this week, scheduled for later in the week, and we're looking particularly for potential talk of a cut in September. Obviously, at the start of the year, we were thinking earlier, but September now seems to be quite a key driver. Another look at the chart, well, that shows that the price is in the upper half of the blue channel, and the median line of that channel potentially becoming support. Price is near the upper boundary of the green channel as well, which is considered resistance. So we may see a retreat from that 20,000 point mark towards the lower boundary of the green channel. It's also possible these bullish drivers will remain in place until September, allowing the market to push higher towards the upper boundary of the blue channel. Obviously, as ever, keep your eyes and ears open. Could be a little bit of a choppy time, but certainly an important level for the Nasdaq to reach. Okay, we're going to turn our attentions to the FX markets now, and particularly sterling, the Great British Pound. That seems to be waiting on the Bank of England verdict. The first half of this week, cable, Great British Pound against the US dollar, stayed above the 1.27 to 1.2650 range, trying to resume its upward trend. Thursday, that could all change, of course, with a rate decision and importantly a reaction to the vote and what is said. That could drive the market forward and up to around 1.2860 or cause the market to fall down towards 1.26, the figure. And we can't rule out continuation of this sideways movement that we've been seeing recently. Now, the rate is expected to be unchanged at 5.25%, whilst we had some good inflation figures out earlier this week in the UK showing it down to the target. Certainly some areas were still higher than the Bank of England would like in terms of inflationary pressure. The vote this time around is expected to be an expectation for 2 people to vote for a cut, or 7 vote for it to remain unchanged. If the vote comes out and it's different, we could see volatility increase sharply for the Great British Pound. If we take a little look at the chart, that shows the sluggish formation of a piercing candle pattern. If the price remains above 1.27, we could retest that 1.2860 to 1.28 the figure range. If the support at 1.2660 is broken, we could see a resumption of the downward trend towards 1.26 the figure down to 1.2540. That would be possible. It is going to depend a lot on what is said, but we are expecting an increase in volatility, so don't forget your risk management techniques. Whilst we're on the FX markets, obviously the dollar also has a part to play. If we take a quick look at the dollar against the yen, that's trying to stay above the 158 mark. The chart shows that there's a strong upward trend across all the higher time frames, but there is data due out that could have an impact on the dollar. Thursday, 3:30, that's GMT +3. We've got the Philadelphia Federal Manufacturing Index coming out. Same time, we've also got US initial jobless claims. And in terms of directly against the yen, Friday at 02:30, again GMT +3, we've got the core CPI for Japan from May. So again, all of these data releases could well have an impact, so don't forget your risk management techniques. Well, we've already had one shock interest rate decision this week, and that was by the Swiss National Bank, who lowered the interest rate to 1.25%. This happened early on Thursday morning, the rate coming down from 1.5% to 1.25%. But the expectation was for it unchanged by the majority of market participants, so it did form a bit of a surprise. Now, according to SNB chairman Thomas Jordan, inflation is decreasing in Switzerland at a rate they would like to see. He also said that in recent weeks, the Swiss franc has significantly strengthened due to geopolitical tensions, and the SNB is prepared to be active in the FX market if necessary. So quite a strong statement there. The market reaction to the cut and to Thomas Jordan's statements was a sharp weakening of the Swiss franc. In fact, the dollar against the Swiss franc was up approximately 0.7% in just the first few minutes after the announcement came out. Let's take a look at the chart, see what that shows us. Well, from the start of 2024 to the 1st of May, that's shown by point B, we have an uptrend shown by the blue channel. From May the 1st to now, the price has been decreasing, forming a descending channel, which we see in red. Now, that may be a correction within the larger upward trend from the low at point A, which was December the 28th. Thursday's shock move created a bit of an upward reversal, and that may indicate the end of the B to C correction that we can see. If that's the case, that's less than the classic 50% correction we're sort of used to. Now, if it is the end of the correction, we may return to that blue ascending channel. Could be hindered by the resistance lines, particularly the median line and the upper boundary of the red channel. And let's not forget the psychological level of 0.900. That could well become very, very important resistance. But as I say, a little bit of a shock to the market and certainly a reaction by the Swiss franc. Okay, we're going to finish off this week back to the commodity markets, and the Brent Crude price hits its highest point since the 1st of May this year. Now, on Tuesday, the price rose to $84.40 per barrel. Now, demand is being driven by predominantly the next couple of factors. Now, one is the holiday season and increased consumption in terms of travel, both aviational and vehicle-wise. Goldman Sachs actually said earlier this month that their expectations for a price at the end of the summer may well rise to about $86 per barrel, with a ceiling around the $90 per barrel, again talking about this increased demand in the holiday season. Secondly, we've obviously also got geopolitical tensions. Ukraine drone strikes on Russian oil refinery plants have certainly caused a little bit of fear in the oil market, as well as the possible escalation in the Middle East. Reuters reported that Israel's foreign minister warned of an impending total war with Lebanon's Hezbollah, who of course are backed by Iran. Those sort of statements obviously cause the market to have some jitters. Now, if we take a look at the chart, the price is within the narrowing triangle that you can see in blue, but it's above its median at $83 per barrel. The price does seem to be consolidating above the descending trend line that you can see in red, but the price has been pulling back since the high appears to be a false bullish breakout of the peak on the 29th of May. So we're not entirely sure the direction in the coming days. It's possible that by forming a bull trap, the price may decrease to that median line, again, the $83 level. And we could see additional support at $81.66. But geopolitical tensions remain. Really important to keep yourself across all of those as well as your standard technical analysis, because any form of escalation or fears of escalation could well drive that price a little bit higher. We wish you luck with your trading for the week ahead. Bye for now.